are live. So welcome aboard, everybody. Thanks a lot for tuning in for this week's Wednesday webinar. There you go, Wednesday webinar.
So, Wednesday before your birthday.
It's my birthday tomorrow, yeah.
That's right.
I'm getting old. Mate. Yeah, thank you, mate. Just doing a little quick IT check. Everyone can hear us. Just give us a yes, no. You can hear our audio, see our video, and see the slides on the screen, and we'll get straight into it. So beautiful, awesome. Yes, it is tax time, so you are in the right place.
We're here again.
We've got our new logo. This is our first webinar that we've had with the new logo and branding, which is really cool.
I'm really cool. Happy. Well done.
Me too. It's great. It's great.
The team did a really good job.
They did. They did. So today we're going to be talking about tax and lots of things to do around tax, increasing your cash flow, talking about the budget.
Yep.
Lots of I hate when those commies take our money. Right? That's, we should call the webinars "Let's Stop the Commies from Taking Our Money" with our bodyguard Ridhwan Hannan from One Path Accountants. So
won't frame it exactly the same way, but that's the essence.
So tonight, just going to go through these things. You guys should all be aware of. The agenda for tonight. It was in the broadcast that went out. So I'll hand it over to Ridhwan. Ridhwan is let's talk about yourself.
Yeah, I'll try for a bit. So for those of you who don't know me, my name is Ridhwan Hannan. We work under the brand One Path Accountants. We have about 10 or 12 people out and about in Sydney, and we deal with property investors all over the country, sometimes interstate, and we deal with a lot of Nathan's clients. And yeah, it's been interesting.
A lot of business owners.
A lot of business owners, trusts, super funds.
Professionals.
Yeah, majority of professionals and active property investors is probably a key core part of what we do, myself included. And it's one of those things where you need to be in it to understand what the pains and joys of property are, as you know, Mr. Birch.
Yeah.
Very close phases. So yeah, a lot of our clients that we work with are active property builders, which is good, but they also change and they also move from PAYG when they get a couple of properties. Sometimes they take on smaller businesses on the side, or they might be in a position where they take some time off and start to live life on their terms. So it is it's always good to see the whole life cycle of the journey for property investors.
And a lot of people out there now are talking about, interest rates have gone up and all that sort of shit, right? And being scared and all that, with good reason, right? Like, if you've got $1 million mortgage, it's gone up by 30 grand a year. But if you're able to push up your rents and adjust things, you're going to be protected. But I'm actually realizing from talking, because I've spent the last maybe 4 to 6 weeks doing about 8 hours worth of phone calls with our investors, right?
Yeah.
And I'm reviewing their portfolios, pushing up their rents, tweaking their positions. And a lot of my investors, I'm putting up their rents for like 40 grand a year, 60 grand a year, right? It's amazing. But it made me think, like, just from chatting to everybody, that this is a time where you really become wealthy if you're buying assets and you're an investor, right? Like, people are looking at, okay, you buy a property for 200 grand, rents for $300 a week. Okay, cool. But what about when you go through a cycle like we're going through now? It goes from $300 a week to $400 a week. And then when you get out, when the interest rates start dropping in 6 months, 12 months, whenever that may be, I reckon it should be now, but yeah, obviously the RBA has its own view on things. And when interest rates drop, whenever that may be, then we're going to see the asset prices rise because they're going to become a lot more cash flow positive and whatnot. We're in a period now where a lot of people are grading a lot more cash flow, like you said about the life cycle of people in the market. And
yeah.
I'm seeing our clients, like some of them that are really able to, I caught up with, without saying her name, right? One of our staff that's been with me, one of the longest staff.
Yeah, right.
And just did a review on her portfolio. I was like, let's put your rent up 40 grand a year, right? Right? And it's like, you can't go to your boss and say, hey, I want an increase of wage or whatever. I just did a portfolio review now. Someone's wage went up by, or their income went up 20 grand just by putting up a few properties. And we're at that point where you're going to see more and more of these people entering the retirement phase than it's over the last 10 years. So
I think it's also important to realise that when you're looking at properties and you're looking at purchases, and I say this all the time to clients, is that don't be tax paralytic, right? Because a lot of people get to that point where they don't purchase because of other external reasons. Something may not be perfect. Obviously, we try and make sure that everything's correct and we structure everything in the right way. But if you miss these waves and these changes in the rental market and what happens with interest rates and whatnot, if you don't control any properties, you don't have access to it, right? So it is really about, somebody said it to me, and I can't actually remember if it was you, is that look at the market that you're in as to whether you should buy or not the market that's gone or the market that's coming. Look at the market that you're currently in to be able to buy and to value buy, for example. So I think that's really important, and obviously the work that you do and the time you spend with clients, I think it's important that everyone sort of takes stock and understands that these situations don't come often where rentals have gone up so rapidly. Obviously, rates are going up, and a lot of people, when they do their tax returns with me for last year, like, I didn't get much back because the rates were so low. And I go, well,
big tax return this year for you.
But on the same tone, 2024 might be even sort of a reversion back to 2022s because the rents have gone up so much. So sometimes it does go in ebbs and flows, and you just got to be prepared for that in that journey, and not sort of kind of tap out too early.
12 months, right? Like 12 months ago, interest rates just started going up. They've gone up a fair bit now. But you look at it, it's like, that's only 12 months. You buy a property, it goes out for 30 years. That's 360 months. 12 months out of 360 is not too much. So,
I think the other thing that you should touch on, you should do a webinar on, is that we have so many clients who are sort of kicking themselves and lamenting that they didn't lock in rates.
Yeah.
And then I end up explaining to a client, I go, you might be to lock in rates for what, 2 years?
Yeah, you'll be coming out right now.
You're coming out right now, right? So the amount that you save incrementally over the life of the property is not significant compared to what you would expect the capital gain to be. And so I think when people take that hat off and they go, you know what, yes, I didn't lock in, but that doesn't mean I don't buy or I don't enter or I don't do whatever you need to do. So I think that looking in the rear view sometimes hurts you from an overall perspective. And we sort of see that in the accounts that we do for clients.
And when you lock in a rate, right, you talk about finance today, but when you lock in a rate, you actually lose your discount. So you have a discount of 3%, right? A lot of people are getting 3% discount now. But what about when the interest rates come down from 7% or 8% down to 4% again? You're really going to be on a 1% interest rate because that stays with you for the life of the loan. But when you lock it in, you lose that when it comes out the break period. So important to look at all the aspects.
Let's get into it.
So I guess on that front, we've had the budget last week. We're living in a world where lots of funny things happening out there, which is exciting to see. It's like get your popcorn out and enjoy the show for 2024 and 2023. The budget's come out. What are your thoughts on the budget?
Look, I probably have not a controversial view on the budget. I sort of thought the budget was neither here nor there. I thought, Labor probably wanted to get a couple of wins on the board. Labor's got a history of having quote unquote poor economic management compared to that of the Liberals. So one big win they tried to get was effectively trying to get the budget back into surplus, quote unquote. It's a very small surplus. It's obviously a big change from what they budgeted for last year, but it's going back into deficit next year. So for me, to some extent, it was a little bit of nothing to see here. We've done well, pat on the back, move on. If we go through, and you'll see as we go through the budget, there are some things which are meaningful, I think, and I think that's fair, and you've got to give credit where credit's due. But I think a lot of the other things realistically don't have a huge impact on the overall life of what ordinary Australians are going to go through. Yes, there'll be some energy saving mechanisms, there'll be some opportunities there, but for things like property, for example, it was really limited. And this list is short because it was short, right? One thing that I did want to mention that wasn't covered in the budget and has been covered well is that if you remember that when Dominic Perrottet tried to bring in the land tax changes, so your annual land tax bill as opposed to a one-off upfront, for anyone who is buying a first home property for themselves, that's actually ending in 1 July. So Labor's scrapping it. So Labor's commitment to, as part of their election commitment, was to scrap it by 1 July. And it wasn't advertised or gazetted very well because some people like it, but Labor needed to sort of have an opposing vision, I suppose. So that's going back to, upfront stamp duty and no longer annual stamp duty on the life or broad-based stamp duty on your principal place of residence. So that's something that you can see that's not in the federal budget. They didn't comment on it, for example. It wasn't discussed with regard to affordability. But there's three quick things that you see here. Potentially, in my opinion, don't necessarily affect the individual property purchases as much as they do, kind of developers or large mid-tiers. So support to the build-to-rent projects, basically they're giving and an increased depreciation rate. So instead of 2.5% on your capital, they give you 4%. So you're effectively kind of halving the time that you need to depreciate this building.
So is this extra depreciation claim, or is it just going instead of 40 years down to 25 years?
Correct. Yeah, exactly right. So basically, they're trying to motivate people to buy these and build these type of properties. And the build to rent is purely an affordability scheme.
Yeah.
So basically, having a developer and or some sort of property owner commit to these build to rent projects, which are very popular overseas where there's density problems. And I think what you're finding is, and what you can see through these measures is that Sydney and all sort of capitals in the States, they're having to consider what you've been saying for quite some time is that eventually they're going to have to go up, right?
Yeah.
And so you can no longer have that. There's a lot more talk if you look at it, even from our, reasonably quote unquote protective Labor governments now. You'll see in the news, NIMBYism is always front and center, saying, hey, we need to slow these NIMBYs down. And then you've got the YIMBYs like Nathan who want everything built.
What's the NIMBY and YIMBY?
Yes, in my backyard. No, not in my backyard.
Oh, okay.
The guys who basically oppose all construction and development.
Oh, true.
Not in my backyard. So look.
Never knew it was a thing.
So it's been really big, right? Because places like Inner City, Annandale, all those areas are all one story. If you look at Parramatta Road, it's all one story, shacks and whatnot near the city. So they want those. And these types of projects and these type of social affordability and rental homes are in reference to that effectively.
Yeah.
The big one there is the one down below, and I think I'll give Nathan a little bit of credit when I can, do you remember we had the I think it was the end of year party or maybe a mid-year update at, what's that place in Castle Hill? The Hills Lodge?
No, that's one across the road, the Rissol, the Castle RSL.
No, it was the Hills Lodge, right?
It was here. How long was that?
Oh, it was a while back. It was just after you bought the motel in Wentworth.
Oh, it was like 7 years ago.
Yeah. And so, and Nathan sort of got out a property, a migration chart. I'm not sure if you remember.
Yeah.
And then you had this image on the webinar and the PowerPoint. So it was a doormat, and you had Sydney written on it.
Oh,
and you go, Sydney, the doormat to the world, right? You reckon they'll need 100,000 homes from now for the next 10 years to be able to account for it, right? And this is realistically what it's speaking, right? So they're looking into trying to build 1 million homes across Australia, not just in Sydney, where they're going to have affordable and use construction projects and use affordable housing and use all those future funds that they've built up to be able to try and create those homes. And, there's a lot of talk that's been happening recently, good or bad, about migrants coming through, 700,000 to 1 million in the next couple of years. Where are they going to go, right? What's going to happen to property prices? And I think if you can look at what the budget is trying to, establish, is to say, okay, great, we need a position where we're going to have a soft-ish landing pad for the next 4 to 5 years, which are going to be difficult.
Yeah.
And we're going to use these types of, landmark, key mark projects to be able to get out there. So I think it's, even though it didn't present the property investors a lot, I think a lot of it is pinned on that.
But once again, right, like, let's say, for instance, they build 1 million new properties, right?
Yeah.
What's the cost of that going to be with inflation, right? If the builder's still existing, right, because they're dropping like flies, they're dropping like sports people out there. Ridhwan, so I don't know what to say to you, right?
We wish the best for everyone.
No, every time you go on the news, there's another collapsed building company.
I don't know if it's you sending me more or it's just happening more. I can't tell.
Well, I've never seen this happen before, right? We have never seen it happen before in life, right? Yeah. And the cost of construction is, they think that it's pushing interest rates up going to stop things. They think that all they're doing is just inflating that bubble a lot more. So if you've got a property in the market of 250K and it costs you to build a new property to match that 2-bedroom, whatever, and costs $600,000 to build it and bring it to market, that means there's a big discrepancy, right? Either people are going to jump up to this level or they're not going to be able to buy that, right? So all the bread and butter stuff will get dragged up naturally with a pent-up demand.
Yeah.
And it's all, the whole financial system, in my view, Ridhwan might say this, but in my view, it's based on a big Ponzi scheme. They just keep manipulating numbers, really. And we look at the manipulation of numbers, they can't print enough money, right? I played this article last night on the Facebook. Should I play it again? I think I sent it the other day, the Peter Costello, where he talks about a trivial debt. Should I play it?
Yeah, you can. Yeah, there was an intergenerational one.
No. This one here is a video of Peter Costello, who was the treasurer of the Liberal Party when the Howard government was in, and he was out talking about literally what we've been speaking about for all this time. I'll just play like a minute of it just for the fun of it.
Because we in Australia are not quite there, but pretty close, at 1%. Yes, it's another thing to borrow $1 trillion at 4%. Even if you just held your debt steady at $1 trillion, the cost of it, the interest cost, is going to go from about 10 billion to 40 billion. It's going to go up $30 billion, right? By about, what, 2030? Well, yeah, as it rolls around. As it rolls around, right? I'm just talking about projection. Yeah. So 6 or 7 years' time now. Yeah. Before some of it's already rolling up, by the way. Yes. Because it's when your bonds roll off, you know, and some of them won't roll off for another 5 years, and some, a very small amount won't roll off for 10 years. But on average, over time, you know, what we were borrowing at 1% will move to whatever the rates are now, 4%. Let's say that's $30 billion of extra interest, right? Well, $30 billion, just to put this in context, that's the Medicare system. Yeah, that's right. So before you've done anything, that's just your cost. Yeah. And the most recent budget here in Australia says, here's a trick question: fastest growing area of government spending in the last year, interest costs. Yeah. Well, you know, you go back.
The fastest growing. We ain't seen this on any news headlines. We ain't seen this out there. But when they jack up these interest rates, it's going to cripple the government. It's going to cripple everyone, right? And that's the exciting part, because it's putting the pressures on the rents. And we look at the rental stimulus packages. We've got these job keeper, job seekers, and all that. I'm seeing and feeling the need for them to put in like rental assistance programs. So if people need rent assistance, they might get $200 towards their rent, $300 towards their rent.
Yeah.
But if you're buying affordable housing, well, then that covers the whole rent. So it's covered by government sort of money. But the thing is that to pay this debt, to pay $1 trillion off, right? The US now has $31.6 trillion of debt. That runs out this week. By next week, it runs out. So they have
36 US,
which is about $45 trillion Australian. So 45 trillion that they have, but they need to increase that to about $50 trillion US, which would be about 80 trillion in Aussie dollar. And what that converts to is like, imagine the interest bill at 4%, 5% based on $80 trillion worth of debt.
Yeah, so I mean, there was actually a really good podcast. I think I've said it on before. If you want to really listen to a really good podcast on especially US related, and now it's getting a little bit more broader, it's called All In Podcast. Fantastic. And they were going through yesterday saying that the US has got now $50 trillion worth of debt at 5%. It's around about $2 trillion a year in interest payments. Now, the tax receipts from the US is $2 trillion.
Yeah.
Right. So all the income that they have theoretically is going to be spent out of the interest. So then any other they take more debt to pay servicemen, to pay social services, to pay housing support, so all those type of things. So that's why you'll find that a lot of articles now talking about, and you know, you sent a million of those videos to me, but even mainstream articles are talking about the difficulty the US is going to have. And one came out today from Stephen Bartholomew, and he's quite good, where China's numbers were way off expectation, because everyone thought that they were in lockdown for last year. When they come out, you know, things will go back to you know, brimming.
Yeah.
But that didn't happen. So they might have to actually go back to quantitative easing to get things going again. So to your point, the not the Ponzi, because I wouldn't frame it that way, but the sort of the capitalist project where you have this ever increasing appetite for capital assets, and those continue to inflate, and you have to make them grow.
It's called a Ponzi. What you're trying to explain is a Ponzi.
Well, you have to make them grow. It sort of has a life cycle, right? So I think that's not necessarily Australia's problem yet. Yeah. But if you think about it, Nate, how much do you think a house in, let's call it Kellyville?
Yeah.
How much do you think that'll be worth in 10 years?
Well, there's people out there thinking the house is worth $4 million today, right?
So would it be worth $8 million? No,
it can't. It can't even be worth $4 million, because the wage won't supply. I actually did a video on this quite a while ago, maybe like 2 years ago, and I said that you've got a whole new market cycle, right? When you take off the interest rates, if you think about interest rates going 1%, 2%, 3%, 4%, 5%, 10%, right? really the interest rate couldn't go up more than 50 basis points. The system can't support more than 50 basis points from all the economic modelling that I've run. But there's actually a whole new model which would be from 1% all the way down to 0%, right? So if they take it down and just move the decimal point over, you could have a property going for $6 million in Mount Druitt, right, which is only worth 300,000, 500,000, a million. It could go up that high, but because the interest rate would be so low, the cost to hold that property, but the ability to obtain that property is impossible because the bubble's getting bigger. So the only way for them to really get out of this and keep some of these debt things from imploding is they can either default on the debts, they cannot pay the debts, which they'll be defaulting on the debts. Ultimately, the other thing is that you can get more, you can add more into the supply chain, right? So you're talking about the US, which has got 350, 400 million, how many people, I think they're dying, I don't know what's going on over the US, 500 million, 400 million, someone will get the stats for us. But the amount of people over there, we are a young country, we've got a land mass the size of the USA, we've got 25, 26,000 people. The ability for us, we can just open our doors and import more taxpayers, right? We can't breed quick enough to get tax slaves, right? We have to find them somewhere.
Sure.
And if we bring in the news articles are coming out now saying by the end of 2024, we're going to have 700,000 migrants. I would just, what's the size of 700,000, right? That's the size of fucking southeast Queensland, right? That's bigger than Darwin population. You're taking the whole of fucking Darwin and dropped it in the country and go, there's some more people, go work and earn some money, right? And as these guys and girls and kids, whatever, come into our country, right, they're going to need accommodation. They're going to need infrastructure, and infrastructure ain't going to be able to support it. So it's going to put a pent-up demand to build more of these cheap properties, but the system can't afford to build these things. So it's just putting more and more pressure in there. And I think that's where the exciting part for most people is, and it's looking at the migration. And the areas that have been picking up have been impacted heavily due to the alleged illness the last couple of years, and people are locked in their homes or whatever. We haven't had the migration. So some areas have been heavily impacted negatively for migration. Some areas that we're very familiar with here in Sydney, in the Southwest Corridor, rents on them have gone up from, they were renting for like $330, $350 a week, went down to like $250 due to, lack of migration to those corridors, and now they're at $500 a week. I'll draw the suburb here just without giving suburbs away. That suburb, right? $300 a week, putting rent increases into $500 a week. That's like 70-60%.
And I don't think they're very flush properties.
They are the shittest properties in Sydney. They don't even have a bar. They don't even have a community laundry. Community laundry with no car spaces, right? 2 bedders renting out for $500 a week from $300 a week. It makes me think, if you go to an area like Mount Druitt, and these areas used to be in lockstep with pricing, and they're starting to inch away. This is going to flood out, and these areas are going to go. So people are thinking, okay, it's not a good yield today. You're buying it for $300 in Sydney, and you're getting $300 a week rents, 5% yield. It's no good. But in a year's time, when those rents go to $500 a week, they're going to be positive cash flow, $150 a week in Sydney, and people are going to think it's impossible. And then slowly the price is going to creep up because they're getting a good return, and your bank's gone broke, and you've got no money in your bank because it's wound up, and the shares that you bought. And
I think that's also, to your point, is that it sort of segues probably towards the end of this webinar, is that when we do our portfolio reviews with clients at the end of the year from a tax perspective, it's always good to look at those in comparative, just like financials, right? What they did in year 1, year 2, year 3. And if they're improving slowly, then, as I said to you at the outset of this, is that we often find that clients, kind of tap out too early, or they get nervous quite early, and which is fine, and I understand that. But you need to let it see through. And I think it's kind of like the government and the budget. The reason they can run these big deficits and they can continue raising debt ceilings, they continue afford to pay, more and more interest, is because they don't die, right? So they have infinite sort of timeline in front of them. I was asking a client the other day, if you didn't have to pay your debt back ever, would you? You probably wouldn't. You'd probably just, continue on. But I guess to another
no one's going to be able to pay the debt back. The governments can't pay the debt back. The corporations can't pay the debts back. Last night after the webinar, I went downstairs and I said, hey, the cafe looks different down here today. And it's like, yeah, they've gone broke, right?
Oh, right.
The cafe's gone broke. They're just closed, right? Someone else moving in there now. And it's like, hang on a second. Like, we're now seeing, like, what's the rent?
Rent will be like 20 grand a year.
It wouldn't even be that, right?
Yeah.
So it's up the stairwell, right? It's a cupboard that they're renting out. And the businesses have got a lot of pressure on.
And, no, agreed.
Yeah.
So I think to your point is that one of the parts of what you're seeing on the screen, and we won't labour on it too long, is that this budget has had mixed reviews as to whether or not it is inflationary or it is supporting of cost of living, right? So they've gone to quite lengths to try and highlight to the fact that they've assisted families and households with cost of living measures in energy, electricity, and incentives, and all these other different things. But at the same time, they're still showing that the economic activity is going to drop off, right? And they can't forecast that away, right? They know it's coming, right? So kind of like land tax values, for example, they're a little bit understated when they come from the valuer general. Your land's probably worth a little bit more, and that's probably kind of like the budget. You probably find that whilst they're being honest and whilst they're being as accurate as they can, they're obviously painting a little bit more of a rosy picture. So if real growth is expected to slow from 3.25 in 2023 to 1.5 in 23-24, that's a big drop off, right? It's 50% odd. So it's going to then go back up to 2.25 in 2024-2025. So you've got to think of yourself in terms of, we don't provide financial advice, but in terms of you as a property investor, how that journey is going to look. Like, are you going to be, you're going to be swayed by that? So they've got some key notes here saying that while inflation remains elevated at 6% for the year, it is expected to fall to 3.25% in 2023-24. And that kind of is in line with that drop off from 3.25 to 1.5. So effectively, you're going to see a big slowdown. And that's the reason why inflation is going to come off, because everyone's going to be in this position.
Stimulate.
And then, the only way that you can get it back going is to printing or to reduce the interest rates, right? So they also believe that the cost of living measures in this budget will take 0.75 a percentage point out or off inflation in 2023-24. I think that's being disingenuous because if the economy is coming off to such an extent, the budget in and of itself is not going to have material impact, right?
But the measures that they're taking is actually inflation in itself, right? So if you think about the cost of living in your house, the cost has gone up. This is inflation that's occurring.
And that's a sticky pickle they're in. That that you find that if interest rates go up, that's meant to come off in terms of economic activity, and inflation's meant to come down. But all the inputs for everyone, because everyone's borrowed, is going up. So realistically speaking, I'm not entirely sure, probably other than petrol, I'm not sure if anything's actually gone down recently, right?
Yeah.
I know all my clients are saying that insurance has gone up for buildings, insurance has gone up for cars, your power and all the other sort of gas and electricity and utilities have all gone up, and I'm seeing the same thing as well. So it'll be interesting to see the next 12 to 24 months. I think you've always been saying that it's coming and it's here. I think they are kicking the can down the road a little bit. But yeah, look, they wrote a budget surplus of $4.2 billion, which is going to go to $35 billion negative next year. So we'll have to see what that moves on to. So some of the tax measures that you can see there, the small business instant asset write-off threshold. So for anyone who runs a business, consulting company, plumbing business, a retail shop, carpentry, any sort of business, professional services, whatever it might be, you've been aware for the last 3 years they've had the instant asset write-off. That's why people are buying trucks and cars and Rams and caravans and the works and bikes and everything for the last 3 years since COVID. And that was effectively, the cap was taken off. So once upon a time, it was back to where it was at 20,000 or 30,000.
But when did that disappear, the cap? When did the cap go back on?
The cap is coming back on 1 July 2023.
So if you want to buy $1 million asset, you buy it now.
We don't give financial advice, but if you need to have assets which are going to be in a position that you're going to be using for your business, whether it's, for example, a tractor, a bobcat, a car, a van, a truck, a B-double, plant and equipment from a business, pre-June 2023 would be the ideal time because that will get scaled all the way back. We've gone all hazy to $20,000 for 2023.
Yeah.
So it is important that people kind of look at that and review with their accountants or with their tax advisors, for example. And my honest opinion is that if you have something to spend, bring it forward. Don't create an expense because we don't know what's coming up, right?
Yeah.
The small business energy incentive is effectively another incentive where they want businesses to be able to have a little bit of a reduction in the cost of their energy. So if you remember, they were changing all the lights and all that type of stuff. And
kind of funny, $33.
Yeah, $33. So all that type of stuff is coming back or being incentivized again. Obviously, there was a lot of problems with that. Started with Kevin Rudd's Fat Bat one, and it just continued on. So this is just a little bit more of that. The next one is really important for some people. So small business lodgement penalty amnesty. So the tax office often does this, where they basically provide amnesties for periods for late lodgers who have been historically poor, for example, in their tax affairs, whether it's business, small business, large business, or actually anything under 10 million, so quite a large business. If you do have outstanding activity statements, lodgements, anything to do with some lodgement obligation between July and December this year, they will remit your failure to lodge penalties to be able to, encourage you and motivate you to get in there and lodge. Right? It's all tax collection, tax driven receipts. It's it's a little bit of a discount for some people to come in and pay 500 grand's worth of tax and not having to pay $15,000-$20,000 of fines.
Yeah.
So if you do have a business, if you do, have
15 grand a fine on a 500 grand, that's like 3% anyway.
No, we lodge our tax name.
Okay. Just doing calculations here, right?
Small business unpaid tax and super. So this is important for both people on the table. So both the business owner and the person who's being paid or the employee. If you believe that you're owed tax, and or if you're a small business who's been struggling to pay tax and super, then it's probably good to get in front of the ATO. There's some amnesties available, but they are ramping up. They're actually giving money to the ATO and more bodies to be able to chase this. And that's a bit of a theme you'll see in this budget. They've given money to ACCC, they've given money to Scam Watch, they've given money to a lot of government departments. And historically speaking, you do see when budgets are like this that they try and fund government departments to account for their spending. So it's one of those things where you just need to be aware that if you're a business owner or if you're a taxpayer, just try to get in front of everything. Obviously, there was news out, the ATO do this every year, I think I sent it to you, is that this particular year they've called out property investors because they did an audit last year, and 9 out of 10 property investors had they had errors, I should say, in their tax returns with reference to the last couple of years worth of tax. So I think for the clients who we deal with, we try and make sure that, obviously if a receipt's missing here or there, we try and understand what that's about. But the best is to keep all your receipts and to keep everything on top of your pile and not throw anything away, so that you can actually get all the tax back and you don't go through an audit process, which can be a little bit traumatic, I suppose. So these little images and icons are basically looking at what the key takeaways for the budgets are. As I mentioned, $4.2 billion surplus. Small business write-off is there, and if you need any advice on that, just let us know. And the business incentive is there as well. That incentive comes into play in a couple of slides as well, because it can be useful for both businesses and employees. Nathan's not going to like it, but we'll have to talk about when we get there. So household energy upgrade fund, $1.3 billion to household energy maintenance and basically any upgrades that allow you to save some energy. So that can be things like solar, batteries, all those other type of elements. So you do need to have a look at that. Once the budget has actually reached your all% pass, you'll see some of those measures come out. 23.4 million to boost cyber warden program to boost cyber skills in small business. So what that effectively means is, if you recall, Optus and Medibank Private and Latitude,
the digital entrapment for everybody, yes.
and all the data breaches and whatnot. They're looking at, and this is an ex-budget thing, but it's sort of in the mindsets of all the government departments, is data theft and data breaches are quite significant at the moment, and there's a lot that actually occur, and you can actually go as a government body which is dedicated to that, to reporting all data breaches. You see the ones that get on the news and whatnot or affect everyone, like Optus, but there are a lot. So Australia needs to effectively protect itself, so that, committing some money towards that. I actually don't know how that actually will work, whether it's an incentive for education and all that type of stuff, but there'll be something in regards to that. Yeah. The one on the right is an interesting one, the minimum tax for multinationals. I was talking about this about 3 or 4 years ago. Do you remember the diverted profits tax? So basically where Google or, a large company like Apple, for example, will have a lot of money going overseas for trademarks and patents and all these other different costs. So they finally implemented some minimum amounts of tax that they will be taxing those type of multinationals for their domestic activity, effectively, right? Mm-hmm. So again, a lot of tax measures to be able to
control and track
and report a budget surplus, right? So all these things are kind of forecasted, right? Now the bottom
on balance sheet, right? Because they're off balance sheet transactions.
Yeah, look, they do. Like, the underlying cash deficit is 13.9 billion, but a budget surplus written at 4.2.
Budget surplus of 4.2.
Yeah.
Which everyone's going to be, they're putting that out in the media, but they're not talking about the fact that the country's in $1 trillion worth of debt. Yeah. And the question I have to greater question that is, who will be in debt to as a nation, right? Who's the controller, right? Let's go up the top of follow the money, right?
So the next two are ones that a couple of clients have actually reached out to me on and wanted to have a chat on this webinar. Georges Brugas, I'm not sure if he's on, but he wanted to understand this a bit more. So basically, they've agreed to pass the superannuation increased tax from 2025, saying if you have over $3 million in assets, then your super fund will be effectively taxed at 30%, right, an extra 15%. So what you're finding is that they're kind of having this equilibrium of tax across all structures of about 30%. So a little bit further down, we have actually maybe not there, but we've been talking about stage 3 tax cuts for a while. So in 2024, 1 July 2024, they're opening up the tax brackets so that now you only have 3 tax brackets effectively, which are taxing, which is 18 to 45,000, 45 to 200,000. So that huge gap is taxed at 30%, right?
Sure. When hyperinflation hits, people will be earning 200,000 like it's 20,000.
So what we're finding is that, company tax is 25, was 30%, may go back to 30% soon. Superannuation's tax for wealthy people will be 30%. Individuals tax for the people earning up to 200,000, which is quite a large wage, will be 30%. So there'll be this kind of hovering 30%. Everyone will be able to say, I get taxed 30%. So it is important. That superannuation tax is distinctly different to what is the $1.7 million cap for a tax-free pension amount. And so that basically means at pension phase, if you have a balance over 1.7 million, only that 1.7 million can generate you tax-free income. Anything above and over that will get taxed at 15%, right? So superannuation is being squeezed because it is, it's over $1 trillion, isn't it? Yeah.
$3.3 trillion.
Yeah,
3.3. It's always at 3.3 trillion. I don't know why, right? It's always at that.
So that's a big pot of cash they have to start to tap because you got to raise tax receipts from somewhere, right? Good or bad, it's not for us to comment, it's what's happening. And you'll find that, for example, that next little piggy bank one, Nathan will love this one, is that employers will be required to pay superannuation on payday rather than quarterly, right? So effectively what it means is that your money is going to go to your retail super funds even more quickly. And I find it weird, to be totally fair, because that means they can lose your money equally as fast, or they can gain on your money equally as fast, right? So if you're doing it every fortnight, their cash flow just goes.
But that causes hyperinflation, right? So actually think about it this way, right? Whatever's invested in the super funds, at that point that they go quicker, it means the velocity of the cash flow going through that system is much quicker, right? Which will most likely cause a boom in some of those areas because of cash flow.
Yeah. So I just don't necessarily fully understand. I think it's being aimed at or pitched with the view that, members will be able to have access or their funds will be invested, quote unquote, more quickly. But that's the good comes with the bad, right? Like if it's in a falling market and, your super fund's not good enough, then it is. So I have a feeling this is one which is lobbied by the super fund lobby because they're quite powerful, where they're trying to, really get more cash.
If you want to see how big of a scam your super fund is, try and roll your super fund into a self-managed super fund because they don't want to pay it out. They don't have the money. They're not liquid. They don't have liquidity there.
It's like if you have like a letter wrong. I mean, I get it. I understand. But if everything is right and have you've left a space, and then they knock it back.
But just the whole process of it is
it's
delayed.
Very delayed.
The fun fact, in super funds, in industry super funds, there's only been 5 years out of like the 35 years that it's been in existence where super funds have been in the negative, right? 2 of those years have been last year and this year, right? So many people that are doing self-managed super funds, they don't actually look at their money that they've got in there. They go, I think I've got about this amount.
You mean like retail super funds?
Retail super funds.
Yeah.
And they're like, ask them how much money do you have in super fund? They're like, I don't know. I think
I've got
about 200, I've got about 150 or whatever. They don't know. Like, imagine sitting there saying, how much money do you have in the bank? Most people are like, I've got $5 grand in there. I've got $200, right? People don't sit there and go, I've got $250,000 in the bank. Right?
Yeah.
And if you said, how much do you have in your bank account? You've got $200,000. You'd be like, yeah, I've got 200 grand in the bank account, right? Because you know where it is, you know what it's in, you know where it's invested. You literally, people are not looking, but when they take a deep dive in their super funds, they're seeing that they had $100,000 last year, and now that 100,000 is worth 102, and they're like, well, it's gone up a lot. Well, hang on a second. Your boss has contributed 5 grand, 10 grand, 15 grand into your super fund this year, so they've made contributions in your super, and you're meant to have made a profit on there. How come it's only slightly marginally up? Because the super funds are not making the money that they're meant to be making, which is what I'm seeing out there.
That, and they gobble up a lot in fees, which you don't see. That's the reality of it, right? So that's not a financial planning sort of blight on my behalf. You know, the whole Royal Commission and the whole space was audited, and you know, there was no, what was it? No fees for no service and all those type of things, right? So that occurred.
Keep the questions coming through, folks. We're going to jump into a couple of questions, but a very important question just got asked by Sarkis. Hi guys, is the tax brackets going to go up in the future? Do you think? Yeah.
I think that these widening of the tax bracket will be rolled back, right? So where you've got, you know, historically speaking, we've had, you know, a more middle bracket, 37 cents and whatnot. And now it's just dropped down to 30 cents. I think that was brought in under Liberals, and I think you know, they were trying to get a trickle down sort of effect. And Labor didn't oppose it because it was well received. I think they may roll it back, and I think I've been telling everyone forever that I can't imagine them leaving super untouched, and now they've just said, well, $3 million is the magic number. Think about it. If you have $3 million in your super fund and it's doing 5%, right? That's 150 grand. You know, in 10 or 20 or 30 years when we retire, it's not going to get you as far as you think, right? So I think if you account for real growth, I think the tax receipts will start to dry up if they don't have a lot of these things. And Australia's not an innovative country. It's not like the US. It's not a mass producer. Once we run out of stuff to dig out of the ground, it's going to be a bit of a problem, right? We're going to have to think of something else.
Just import more people, and then we can produce shit by making houses and stuff like that.
Yeah, exactly right. So you've got a lot of different type of demand than we have now.
I have a very different view to answer that question for everybody. So do I think the tax brackets are going to go up for future years? People are being taxed so much more right now that they don't even realize, right? And I actually think taxes have gone up tenfold when you really break it down, right? So what I mean, let's say an average house price in Sydney was worth, I don't know, 500 grand, and now it's gone up to $1 million, right? When you transact on that, the government's now getting stamp duty based on $1 million, not on that. And when the real estate agent makes his commission and charges you 2.5% for selling the property, he's getting paid 2.5 on $1 million, not 2.5 on 500,000. So the expenses have gone up. So the cash flow and the velocity of that money that's flowing through the economy, the more that they inflate the value of things, they're copping bigger tax cliffs by pushing up the value of that transaction that's occurring. So if you ask me my view, I think tax has gone up. Like, let's say, for instance, let's build a scenario where we've got an economy, we've got someone selling their house, right? Their house sold previously for 500 grand, now it's sold for $1 million. So when they go to the real estate agent gets 25 grand instead of 12.5 grand for the sale of the property. The real estate agent now has more money, so he goes and buys his wife a new breast enlargement and buys himself a new car and buys some furniture, right? So then the doctor that goes to do that gets more money, right? The car has gone up in value due to inflation. Inflation is the hidden tax that everyone's being taxed on just because they're having to spend more just based on that. But they're also the velocity of that trickling down. The guy that bought the car, the guy that got the new suit, all that, are spending more money, and those profits are being taxed, the GST revenue is being taxed, the GST on the car at $20,000 or GST on the car at $50,000, that's $2,000 versus $5,000. So they're getting more tax out of it, you're just not realising it.
Yeah, look, the organic growth of that, I mean, that would counterbalance that. We're saying that, that the inflation there is also eating away, money, and people are earning more.
Sorry for my very graphic, funny scenario there.
But I think to some extent is that bracket creep, that move that we're seeing there with respect to that. I think they will have to undo those tax bracket changes, to be honest with you. But Nathan has a theory they never undo anything, but they did.
What do you mean?
Kind of undo JobKeeper.
Oh, they'll make it in a different one. They'll just package it back up. I saw something in there, Job Seeker still there.
Job Seeker is also
yeah.
So
we're going to hear the
continued measure. Yeah, so that basically increased bulk billing incentives for elderly, concession card holders, and children under 16. So they've changed quite a lot. They've actually tripled almost some of the incentives. But your middle population is still exactly the same. That's why you have a lot of your doctors gap billing at the moment. However, I think this is probably one of the areas where Labor's sort of put down a couple of breadcrumbs, and then next election they'll go, hey, now everyone's bulk billing is going to be increased, and so then less gap billing, less cost to individuals to see doctors if they're getting gap billed, for example. I do have a bit of a gripe. I don't think a lot of people are being gap billed in Southwest Sydney and Southwest areas.
What do you mean by that?
So how like if you go to the GP, you just swipe your Medicare card and you walk out.
Yeah.
Some places you swipe your Medicare card and they charge you $20 on top, right?
Okay.
So that's happening because of the cost of practice management is increasing, right? So that's going up. Doctors will get more monies, practice will get more monies, which is theoretically going to give everyone better healthcare. Aged care workers are getting a wage increase because of the Royal Commission into that space as well. And then getting more welfare support, job seeker. It's going up, not a huge amount. I think it's $20 a fortnight, to be honest with you. And then Commonwealth Rent Assistance, was it $40 a fortnight? I can't remember. It's not very much. And Commonwealth Rent Assistance is increasing by percentage amount. I think they're spending $2.something billion over the next 5 years. So these are the problems that people are sort of saying about the budget, that it's a little bit inflationary, you're giving more money. It's like wage increase is good because they need wages to go up to support what would otherwise be more stickier inflation, higher interest rates, all that other type of stuff. So it's kind of a push from the government. It's not a bad budget per se. I just don't think it did a lot. I think it's just more about that headline surplus, right? As opposed to, there could have been a lot of different things. They could have capped, certain pricings on things. They could have changed GST measures to be able to make sure that, luxury goods or particular things are getting taxed more heavily. So there's a few things that I think that they've missed, but
maybe if the Labor government doesn't work for these politicians, they could go into the cooking industry because they're likely to cook the books here, so they could all be the chef. Albo the chef.
We're seeing what's happened recently in that space anyway. So a couple of things I wanted to revisit that I said earlier on we would. Tax budget, so tax measures from the budget. FBT rules for electric vehicles. Now, Nathan hates electric vehicles, but I think they're all right.
Yes, I'll drive you straight to your prison camp, and I will say, well, you haven't paid your tax on time, so we're not going outside of the 15-minute radius to your house where it's pinned to and registered to, and they can control you from that. So.
Yeah, Daniel, that's a good question. We'll come back to it a little bit later. So basically, what it means is that fringe benefits tax, or FBT, which is otherwise applied to benefits or benefits that you receive from your employer, which effectively reduce your overall amount that you get in your bank account if you were to say novate a particular vehicle, like on a novated lease, or from a business perspective where you're giving a benefit, they've got rid of FBT. So effectively what that means is that electric vehicle, a lot of it, what you're paying pre-tax if you are an employee, you can get, and you don't have to pay, or they don't gross up what will otherwise be the FBT amount. So we did some quick math. You're probably saving about 15 grand or maybe a little bit more. And that's extended to businesses where they basically said, they have said that the FBT rules don't apply for private use for associates or family members. So they're trying to promote electric vehicle usage through these rules, so that a lot more electric vehicles are on the road.
So you get your electric vehicle and you plug it into your coal power station to get your petrol out, and great thing you're doing it for the environment. But anyway, I actually said about this in the mentoring program we did in 2018, that they would build stimulus packages based around green, and they'll start rolling out these control grids that are made from that. And it was like 5-6 years before they did the lockdown, before they got everyone up. It's interesting when we look back.
Jock's question there is interesting. He said, I understand that the change in the super to be paid on the same cycle as pay is mainly to create better transparency around the amount paid by making it easier for people to check that aligns with their pay, what's on their pay slip. I think that's definitely the headline thing, Jock, as in that's definitely what you'd gazette and advertise. In terms of how much super you actually got paid, whether it's quarterly or weekly or fortnightly or whatever your pay cycle. Some people get paid monthly, right?
Yeah.
It should show up, right? So that's the reality. So whether you've got it or not, it should show up in your pay slip. But yes, obviously, if you do it fortnightly or weekly or whatever your pay cycle is, then you have more rope to hold on with your employer. I just think that obviously if the good comes with the bad. I'm not saying it's a bad measure. I think it's if the market's going terribly and they're investing more, then you're going to be losing more.
They also said it would take 2 weeks to flatten the curve, and they also said that these things that should be done in the world should be done for the betterment of everyone else, and it was based on fear and propaganda. So
look, it's a crazy world.
I love making you feel uncomfortable.
So the build-to-rent properties, I think it was Peter White already. He actually asked, build-to-rent support package is aimed at bigger corporations and large developers, though, right? So I think that's probably true, Peter. I actually don't know any clients who have done a build-to-rent scenario other than large developers, because it takes a bit of scale and obviously you'll be selling. So there's going to be a little bit of funding that's associated with that. Usually why they're bringing these measures on a larger scale, it does filter down a little bit, but it means is that they're going to stimulate the economy that way. So if you give, I think it was pretty much as they brought this measure out, I can't remember who it was either Leighton or Lend-Lease or some big developer had sort of pushed through a project in Brisbane to do a big build-to-rent scenario, which they were waiting on to see what the tax measures were. Obviously, that's advertised because they know it's advertised. They sort of stitch it all up together, and they say, well, we've released this measure, and now look, one of our big companies in Australia, really good companies, is doing this. So, the reality is, I think it is aimed at larger developers. I don't know how it would actually work from an individual perspective per se, but you take a little bit of time because the person who's buying the property is renting it off you from the life of the loan. Nathan's a bit of an expert in vendor finance, so you might know what to do.
But I guess the other aspect of it is that a lot of these things are. I actually remember when we did in 2016, and we did the cafe in the financial year, and we talked about. I remember having the Zinger team go up, and they were talking about finance changes, and then the legal team went up and talked about legal changes, and then we had accounting come up and talk about accounting changes, financial planning come up, talk about financial planning changes, and I came back and I said, every person here said about your digital identity, right? Everything was digital identity. It was when they had the Medicare thing that went digital and all these digital things, right? And I just feel that the things that are going into place now are more, it feels like a control, right? It's a control. It's a big brother. It's a technocracy, government control, overlord, overshadowing. So my view sits on that side, on that front, as far as these electric cars and the you'll own nothing, be happy style agendas.
All right, so we sort of pass on through the budget. There is a lot of information with regard to the budget, and again, I didn't think it was super fantastic or knock your socks off. Some of the other budgets Nathan and I've covered have been a little bit more exciting, some for negative reasons, some for positive reasons. But
it's funny, they say that the Liberal Party was the Conservative Party, Labor goes and spends on all random shit and all that sort of stuff and leaves the country with a lot of debt. When you look at the last 3 years, there was a Liberal government that was in there, and it's the most communist spending that I've ever seen and got us into so much debt. It's just amazing.
Yeah, look, amazing, I'm not sure is a word, but certainly that's...
No, amazing to sit there and watch it. It's like a car accident. It's like, you look out the window of the office and you're like, oh, there's two people having a brawl out the street. Come here, Red, look at that, right? It's like, it's a disaster, right? But it's like, you're not involved, it's just watching it unfold. And
I think in fairness, their attitude to being a little bit more conservative, delivering a surplus, whether that's just cursory or in real terms, is good, and it's a little bit better. And I think they're trying to get people used to less free money because we saw kind of the inflation spending happening.
I think if we look at the end of this political term that these guys have, a lot of people are going to turn back and say these guys fuck the economy, right? I think that we're going to see that. I'm politically atheist, so I'm not saying Liberals better than Labor or anything like that. But when you look back through it, like so many people go, "Oh, Keating, he wrecked the government," right? And it's like in the Keating era, he didn't have any control, right? It was the central banks, it was a bond market, it was a global market. Every country had a recession at the same time. So these guys blowing up because of debt that's there, it was placed there. Places there.
Yeah,
and that's everyone should be looking at.
So this part of the webinar, we're going to move into a little bit of tax talk. So Nathan's got a lot of commentary on this, so we can sort of take some questions as we go, and we'll get into it. So tax depreciation is one that Nathan and I talked to death about, which is if you have a property which is an investment property, new, old, oldish, it's always good to get an assessment from a depreciation report company to determine how much depreciation you may or may not have left. Someone like Nathan, someone like a lot of the property investors we have who don't intend to sell properties, depreciation is a one-way street because you're consistently claiming against the property, but you're not actually selling it, so you don't have to pay it back. But it is also important to know that if you do sell a property, the depreciation is added back and you're taxed on it. So it is one of those things, but you're only taxed at the capital gains discounts, usually if you hold it over a year. So it's only half the actual quote-unquote damage that you have to repay. So I think what's important is that a lot of people do renovations and a lot of people spend money on properties when they're pre-selling or they're getting them, for example. Even if you're spending 6, 7, 8, 10 grand on a property and a depreciation report costs you $400 and you stage it right and you do everything right and you provide your depreciation report company with your scrapping and your wastage and all those other type of things, the depreciation the first couple of years can be quite good. So often clients go, look, is it worth it? So I say, well, I'm not a depreciation or a quantity surveyor, so let's go get a valuation or let's go get an assessment on that. And often, even sometimes it surprises me. Yeah. You might find that a property which is reasonably old, 10, 15 years old, it's still got, $5 grand a year. Well, even, $3 or $4, $5 grand a year for the next 10 years, and it costs you $400 or $500 for the report. It's not bad, right? Again, if you're selling it, we've got to wear that cost on the way out.
So when you say that, you mean that you got to repay that tax, like you can't offset that against it.
Yeah, no, correct. So for example, if you've claimed $100,000 over the life of the property and you've got the tax benefit of that, 47% or 40%, when you go to sell it, you then have to add that back. But because of the capital gains discount, it comes in at 23.5% that you have to pay back. So it's still useful.
Soon it'll come back at 15%.
Yeah, potentially. Yeah, exactly right.
30%.
When it's 30%, it'll come back, right? So it's definitely the case where it's going to improve. So it does lead to slightly better cash flow because depreciation is a non-cash deduction, and so it can basically help lower your tax liabilities or increase your cash flow. And sometimes we've seen that clients get a depreciation report over the first 6, 7 years. They're actually doing really well on the property, and then it starts to even out in terms of it's positive and negative gearing. So you've got to take the same way that clients and individuals are sort of quite focused on making sure that the dollars are going as far as they can when they're purchasing with you, when they're getting legal advice, accounting advice. It's also good to do that inside your own property portfolio, right? Yeah. So depreciation schedules are always useful, and if you need advice on getting one, give us a call, give Nathan's team a buzz, and we can certainly head you in the right direction.
You've got a deal which we get, I think it's like $100 discount or $150 discount for getting in bulk for our clients. So reach out to us if you have a property and you don't have a tax depreciation report. We can put you in contact with the right people that can do that and get the discount for you.
For sure. So preparing for your tax return, this I'm going to couple with end of financial year that's coming up. We've got tax coming up end of tax year coming up in 6 weeks. So if you do have expenses that you've got, courses, equipment, headphones, all those things you use for work, webcams, bits and bobs, stationery, all those type of things.
Does everyone use webcam for work or?
What we're using now.
Oh, true.
Yeah, right.
I always thought webcams were something else. Everyone uses Zoom nowadays. We're in the 21st century.
So yeah, look, if you've got those things that are you're using for work and you need to upgrade it, for example, then certainly before end of financial year is a good time to do it. That's also relevant for businesses. Again, with the instant asset write-off on the higher end actually coming to an end, might be useful to clients to see. What I will stress, and I stress like a broken record, and people must be sick of hearing it, is that ATO's audit activity is very sophisticated. It's going up in terms of the activity. We've probably got a lot more rental queries than we have in prior years, not because we do anything wrong, but because they're just auditing everyone.
And what sort of queries do they get around the rentals?
Yeah, so it's a lot of different things. So they want interest, for example. So they want to say basically, when did you buy that property? What was the originating loan? Is the interest different? Should the interest be going down, up? All those type of things. So if you've got clients who have taken equity out and moved to different properties, they actually say, okay, that's fine, but we want to see the very first loan statement, right? And sometimes that's 10 years ago, right?
What happens if you can't provide from 10 years ago?
So you provide as best as you can, and you can sort of go back as far as you can go back, and then you've got to make assumptions and have conversations with the tax office, and they're quite good with that. But it's just to ensure that clients are not over-levering properties and then claiming tax deductions in excess of what they're entitled to. Mm-hmm. We have repairs and maintenance expenditure. We have capital versus write-off amounts, for example, or repairs. We had one this year which was regards to bank fees. It was ridiculous. So all these type of little bits and pieces, and they did find, I think in the recent report, that 8 out of 10 or 9 out of 10 in property investors had incorrectly reported some or any of their income. Mm-hmm. But if you do everything right, gather all your documents, make sure that you calculate everything correctly, ask us the questions, identify certain deductions which you may or may not be aware of. It's always good to ask questions. And the last one there, talk to an accounting professional. It doesn't have to be me, but get in front of someone that you can talk through a conversation with. Like Nathan and I talk about a lot of different things, strategies, this, that, and the other. Sometimes it's just about talking it through and understanding. So it's one of those things to be in good contact with your accountant. I know myself, during tax time, I'm hard to get and whatnot. And we're in tax period now for last year, so it's been a bit difficult. But shoot emails, be a little bit persistent. If I haven't got back to you, get my team to chase you or anything like that. I'm always open. Nathan sometimes will send me text saying, hey, this guy's chasing you, and I'll call them back straight away because we just deal with so many people. But the reality of it is just talk to someone, have that human-to-human interaction. Don't make a bad decision just based on research or whatever it is.
Cool. Awesome.
How you can minimize your tax. Minimization is, Kerry Packer said, you'd be mad not to minimize your tax. So utilize tax deductions. Credits there is probably referring to things like franking credits and whatnot. But utilize tax deductions which are available to you. This year, you're going to find that your tax return is going to be a little bit less in some regards because the low to middle income tax offset is gone now. So everyone was getting $1,000 extra from the old Liberal government. That's been pulled. So your tax return will be less this year, but maybe your interest has gone up, for example, on some of your expenses, and your rent hadn't sort of caught up yet, so you might be sort of square. But I always tell clients, don't focus on your tax refund, focus on your tax position, right? If you're paying a low amount of tax, generally speaking, that might probably mean you'll get a smaller amount of a refund back, but that means you're paying a lower amount of tax. So focus on your position, not the money that's in your hand. It's important, but it's certainly it's good to stay informed about what your position is.
You want to be picking up all the pieces on the chessboard.
Yeah, that's exactly right. Yeah. Always get the king in the end. So how to buy property in super fund. I know Nathan wanted to spend a little bit of time on this, and I was looking. We've actually got one of my old drawings on the actual board here next to us. Has been there for a while. Yeah. So
probably etched onto the board there.
Yeah, I don't think it's ever coming off. So basically, we've spoken to a lot of clients, especially in the last 2 years, who have been seeing underperforming super funds, for example, with the view to consider what they can do on their own accord, right? Now, super funds aren't as easy to set up as what they once were. With respect to professionals' advice, a financial planner is generally needed. In some instances, you can,
unless you're a sophisticated investor.
Unless you're focused on getting a property and you're going off and setting it up yourself, or engaging someone to set it up for you, and then coming and getting all the advice from the relevant brokers and whatnot.
So by law, you need to have a financial planner that can execute it, give you advice, give you a statement of that. But if you're like, let's say, for instance, me or someone with 5 properties or whatever, they're serious, like a sophisticated investor,
yeah.
and they know that they don't want to be in their super fund that is, if you're sophisticated, you don't need a financial planner because you.
Yeah, I think the way to frame it is that if you're in a position where you have a targeted investment type, which is property or metals or something that you can't necessarily access through a retail environment, and you're confident that you can do it, and you understand the risks and benefits of that, and you consider yourself sophisticated because you have properties, like if it's your first dabble into property, then it might be a little bit difficult. Then theoretically,
if you've got like 5 properties,
if you've got 5 properties, for example, then setting up a super fund on your own accord or instructing someone to set it up with regard to the structures that you need to be able to go off and buy a property, that's where the tax office, probably won't have the most impact in terms of discussions with you. I had it the other day, a client got an entry interview as to why they're setting up a super fund, and the client is sophisticated and the client had a view to buy property. The tax office are fine with it, right? So using a financial planner is also useful because of the insurance mechanisms inside of your retail fund. Using a financial planner can also be good to get some diversification. So you could have property, metals, small amount of shares, for example.
Don't know many financial planners that suggest that you go and buy metals or anything
that's true.
of use, right?
That's true.
We're not financial planners. We can't give you financial advice.
No, unfortunately not.
When it comes to metals, when it comes to other alternative sort of investments, when it comes to crypto, when it comes to all that, I invest in things. That's why it's called B.Invested. It's not called Birch's property company.
We call you one-ton Birchy.
For many reasons, but a ton of cash, right?
So I think when you're looking at super funds, I think it's important to have a chat. We see heaps of clients who want to do super funds, and we knock a lot of clients back, to be honest with you. I think Nathan does too. It's got to be right for you, and again, you've got to have a targeted investment in mind. But it does give you the option to be able to quote unquote control your super. But it is important that you comply with all the regulations from the ATO. No accessing your super, no early access, no problematic investments. Yeah, exactly right. So as long as you're doing the right thing, I think it's okay to consider what a self-managed super fund would do.
Looking at the returns, like I can't give financial advice, and then Rid might get a couple here.
Sure.
But sure, let's bury our head in the cup. With looking at the performance of a super fund, right? When you look at a financial planner, the financial planner gives you advice. Bill needs to go and buy some shares and some managed funds and whatever, right? They have their view. When you look at a self-managed super fund, the thing I like about it is that I can go and buy property under it. I can go leverage that property underneath it. If the tenants don't pay, I can go to the house. I can go knock on the door. I can say, "Hey, where's the fucking rent?" Go in there, whatever, right? You don't sit inside that you go and throw your tenant out the street, but you can look at it, you can see it, you can touch it, you can feel it. When it comes to a super fund, you've got maybe 150 today, maybe you've got 200k invested in your super fund. You don't know how much you've got in. You don't know who the grubby mitts are of the person that's making those decisions to buy, sell, or whatever. When the stock market went down in February 2020, what did your super fund do, right? What was the performance of that? And I feel much more comfortable. I would find myself feeling like an idiot if I had my money in if I had my money in an industry super fund. If I had more than 150k or whatever personally in an industry super fund, I'd feel really robbed from the amount of fees that are being charged, what it's invested into, and the lack of control of my own capital. And the super fund would be my own capital, even though I can't touch it. It's in trust for my retirement. But there's, when I set up my self-managed super fund, which was more than a decade ago, I feel like it's been a great benefit to be able to do so because I can control and manage what's inside that.
Look, there's a counter-levering view, which is, for example, super funds have opened themselves up to have a little bit more member input, so you can control some shares and stocks and everything that you're purchasing, right? But I think that lends itself to the understanding that people would like to control a portion of their super. So
although they have control, but they really don't, because are those shares actually shares, right? When you go to roll over a super fund, they don't have the liquidity there, right? So we've seen banks go broke because there's no bank guarantees around it, right? If there was a run on super funds, what would happen to the whole stock market? What would happen to the liquidity? If there was a run on super funds today, if everyone went out and walked out and set up a self-managed super fund, the whole stock market would collapse.
Yeah, look, I mean, to your point, Nathan, is that a lot of the SMSF activity and a lot of the SMS throttling has come from super lobbying, right? Super retail lobbying, right? So I don't think that's anyone's hiding away from that fact. and quote unquote ensuring that members and taxpayers and Australians have super to retire on. They don't want people to effectively quote unquote piss it up the wall. But a lot of the throttling on SMSF, the world finance and everything like that has come from the lobbying, right? So it is important to understand and look at that, and then whatever control you'd like to have on your super, self-managed super fund can assist with that, but also there are retail options as well for you to consider.
We're sitting in the world today, 2023. I keep saying 2024. Don't know why, but we're in the year 2023, and we're sitting in a place where the banks are going bankrupt. Right? Who would have thought? You've got the governments that are going bankrupt. You've got the banks that are going bankrupt. You've got countries that are going bankrupt. Currencies that are going bankrupt.
What did you say to me this week? Whose rates are 97%?
So Argentina, right? Argentina currency has crashed so badly. They've had a hyperinflation, and now they've got a 97% interest rate, right? And people might sit there and go, oh, 97% interest rate, imagine that here. What you've got to remember is that the inflation's been like 100% on top of 100%, right? So it's doubled, and it's continuously going up. So hyperinflation. So if interest rate was 97%, that would just be attached to a little bit of debt that they're trying to pull out of the market, but it wouldn't really do much of an impact anyway, because it's only a small section of the economy and it would really cripple things. So it's fun to watch out that, we've literally got currencies around the world going bankrupt. We've got governments going bankrupt. We've got corporations going bankrupt. We've got stock markets going bankrupt. I know, sure as fuck, I wouldn't trust. You've seen Wolf of Wall Street, you've seen all those shows. Those people with the, snorting the cocaine, that is your industry super fund, right? That's the people behind there with your super fund. And they've got your super fund and they're having a big old party out there, charging you fees, putting you into dodgy investments, and you have no idea what's going on with your money. You don't know where you get 150K is, or your $200,000, or your 300 grand. I would prefer, especially in the volatility in the world today, to know that's exactly where my capital is. I do not trust those paper markets.
Yeah, look, I mean, that's what a self-managed, quote unquote, the name is.
Yeah.
You're managing it. So
if someone's a sophisticated investor,
yes,
reach out to us. We can put you in contact with Ridhwan and you can set up your own self-managed super fund. If you're not a sophisticated investor, you've got two options. One is to become a sophisticated investor and get yourself educated to be a sophisticated investor, or you can go to a financial planner, get some advice from the planner, and be able to set up a self-managed super fund. So, yeah, everyone's got a super fund. If you have one and it has more than 150K, I don't think you're doing yourself a favour by having an industry super fund, and that's no financial advice. So if anyone from the authorities are watching this, you can go get stuff. Move on next slide.
Property tax deductions. So we've gone. Sorry.
Let's go back there for a second.
Yeah.
What is the benefit of having a self-managed super fund as well? Not just that you've got control over the asset, but it's very grey area here, so very confined with what I can talk about, right? But one would imagine if you had $200,000 and the stock market did go up, your super fund did go up by, say, 5%, right? And no super funds got up by 5%. They're all up at like plus 1% for the year or negative 2% for the year. Yeah. So let's assume that it just did go up 5%. Your 200 grand in your super fund would go to $210,000 because you had a 5% growth on it, right? But if you had taken that 200,000 out and put it in a self-managed super fund, and just hypothetically say that someone had 50K that they put into liquidity and kept it there as cash or whatever, and they had 150K sitting there, and you use it as like a deposit, you could buy maybe two properties for like $500,000, $600,000 worth of assets. Let's say someone buys $500,000 worth of asset, $300,000 loan, 150K cash as deposit. You would then have $500,000 worth of asset that would be going up in value. So if it goes only up at 5%, that's 500,000 going up to 5%, so it's 25 grand in growth instead of $10,000 in growth. But you've got the asset that's increasing in value, but you've got one other thing that's occurring as well, and that you've got the cash flow coming in every week of 7%. So you're really getting like 10%, 15%.
Less your finance cost.
Less the finance cost, but those properties pay themselves down inside a super fund because they're non-recourse loans. So then that thing might pay itself off in 15 years. So then in retirement age or whatever, one would have the assets unencumbered. And instead of having 200 grand that might turn into 400 grand, you'd have 500 grand that might turn into $1.5 million.
Yeah.
So,
and look, and super funds across the board, retail or self-managed, at current state, even if they're less than $3 million, or if when you're in accumulation phase, they're getting taxed 15% on any gains, and if they're less than $1.7 million in pension phase, they're getting taxed at 0% on any disposal or income. So it's not a bad space to be in. But
it's also a tax haven as well. Like, it's something that's very good for tax when you go to retire.
Yeah.
Some people have in their strategy that they would, they might have 200 grand, they might buy 500 grand worth of property, have cash sitting in there just as liquidity to be safe, and that's without new contributions going into it. But then in a period of 20 years or whatever, that 500 grand turns to 1 million and doubles, and it turns to 2 million and doubles. So you might have $2 million at retirement age. If someone was to sell that property, they'd pay next to nothing in tax.
Yeah, that's what I was saying. It's less than 1.7, you'd pay no tax.
So you don't pay any tax on it. You'd be able to pay it out to yourself, and then I'd be able to, let's say if it was me, I'd be able to then take that $1.7 million and pay out 10 investment property loans at $170,000 each, and have 10 properties owned outright unencumbered at that point. Yeah. And that would be my retirement at that period. So
there's other estate planning mechanisms which go into that. So it's always good to have a chat with us.
Kylie here said, how long does the process take to set up a self-managed super fund? Do the super funds make it difficult to do?
I meant to get back to Kylie. She emailed me. So look, they do take a little bit of time, Kylie, and depending on what your situation is, how low your balance is, for example, as well. It does take time. So you're probably looking at 4 weeks to set it all up. It used to be much quicker in some respects, and it used to be slower in some other respects. So setting it up now is much slower. Getting the super fund money out once you finally pull the trigger is actually faster, because the super funds are compelled to do it by the tax office, right? So, but they keep knocking you back where it's a little bit slower. So, I will come back to you this week, Kylie. It's just been lodgement week, so I do apologise. Is the $3 million threshold based on the net valuation of the SMSF assets? Yes, it is.
But who values that?
So every year the super fund has to get valuations now from valuers.
For every property?
And yeah, so they're going to move it to every year. At the moment it's every 3 years. But it's moving to every year from like a registered valuer.
They can't just use land tax?
No. Property tax deduction. So we've gone back in a little bit of a swing and roundabout. So obviously everyone knows about the big ones, mortgage interest deductions. You'd be surprised how often people forget that. You will be surprised.
They don't claim that.
No, they come into the office and they go, I forgot about it, right?
Really?
It's funny.
That's the biggest expense that one would claim.
Because everyone's thinking about it, so it's sort of it's hidden in plain sight. I think that's the reality. No one forgets about it in reality. But yeah, depreciation deductions, repairs and maintenance deductions, insurance deductions, so insurance premiums, obviously, professional fees deductions. Yeah, so for example, you might have a property manager who's assisting you, or you might have a whole bunch of different professionals who might be doing fire, smoke, and all that other type of stuff. So all those property tax deductions, I say this every year to every single client. It's nothing to do with Blink or property managers or anything like that. Is that if you get your property manager to pay majority of your expenses, you're likely to miss less, right? And it means that our job is more analytical rather than data entry, right? So then we can see, okay, great, on this income and expenditure report here, you'll be in a position where you can actually go, okay, well, as a snapshot, this looks okay, but is it missing council? Is it missing strata? Is it missing a water? Is it missing ABCD, right? So a lot of clients, when they have 4 or 5 properties, I see them really fatigued. I see them really in a bad way. We have another client who I think I put onto Kieran for My Property Tracker, for example, right? It's a useful tool, right? I'm not saying it's because it's
mypropertytracker.com.au, I think it is. It's a bit of software created years ago.
Yeah, and look, and it's not super, it doesn't look super flash like the new logo and stuff, but it works quite well, right? So you upload documents, or however you keep your documentation, even if you upload it to our cloud file, for example, and we have it. We prefer you have it, and it's really good if it's on the actual income and expenditure report there, so that way we can go, okay, great, we've got something in our cloud or in documentation format, and we've got this piece of paper, we can then match them off. So it is really good just to stay on top of your paperwork. And if you've got, like Nathan does, or you've got like a lot of our clients do 10, 12 properties, you don't want to be doing 40 council rates, 40 strata, 40 water, all that type of stuff and paying them each quarter. Yeah, you go mad. So you might as well get your property manager to do it. Yeah, they charge you $60 or whatever it is for the year to do that. But in my opinion, it's money well spent. Yeah.
I've got a question here from Jason, and he says, is strata tax deductible? Yes, that's another one. Basically, anything that if you didn't have the expense because you didn't have the property, you could claim that.
Yeah. The only limitation to that, Jason, is special levies. Sometimes they have to be depreciated depending on the nature of the actual maintenance work. Like if they're doing groundwork, for example.
Here's a good one from Luke. Can you claim legal and building inspection costs for an investment property you don't eventually purchase due to a failed inspection?
So Luke, we claim those as capital losses, not income deductions, right? So the capital losses. So basically, we have a lot of clients who have that. So basically, it was an investment that you're trying to make. That investment failed in terms of the property. So then we claim a capital loss. That capital loss carries forward until you have a capital gain. If you might sell a property, we've got clients who've got tens of thousands of dollars in legal and building to carry forward from when they actually sell. Mario there, I think that's also tied in with Fabian's one. Travel to visit, to collect rent, do any of those things is now limited. You can't do anything. In some limited instances, if you're actually conducting works for properties and doing renovations and whatnot, there may be scope to claim some of those travel costs depending on what it is. But generally speaking, travel costs for properties was kicked out by Malcolm Turnbull.
It's a strange one, eh? We would have thought he would have been pushing for that sort of thing.
Oh, I had to give something up, and I was going to lose negative gearing. So this is a really common one, and sometimes a little bit of a painful one, to be honest with you. So tax on crypto, shares, and any other type of traded security. Capital gains tax, same applies for properties. If you hold something for more than 12 months, then you'll be in a position where you might be eligible for a capital gains discount. Anything held under 12 months, it gets taxed at the full tilt. So often you'll find that clients are willing to try and risk some of the price exposure to be able to hold out for that 12 months, so they get the capital gains discounts. Is that a good idea or a bad idea? It's tough to say. Obviously there's been a lot of rough rides in the share market over the last 12, 24 months. So sometimes it hasn't worked out very well for clients to hold on and try and stick to the capital gains guns. And sometimes money that you have and you sell, even you've got to pay tax, is better than not having it, right? So the holding period there is 12 months. That's a minimum that you must do, so 12 months and 1 day. And it's always good to do that. One thing that people often overlook is if you coming into the country new, or you've been overseas, like some of our clients have, and they're relocating here, for example, or relocating back, I should say. If you have securities that are sitting outside of Australia, so they're in Hong Kong or US or whatever it might be, the day that you either jump on the plane and resume, or your intention to resume your residency here, that's the date we get to value those shares or even assets like properties, for example.
Yeah.
So often clients go, oh, look, I had a property when I was overseas and now I'm coming to Australia. Do I have to pay tax from when I bought it? No. If you came in, on the 2nd of June into Australia and you sold it, the same time next year, you get to use the cost base of when you actually came into the country. Okay. Dividend tax is an interesting one. It's tied into the next one, franking credits. So basically when you receive a dividend from BHP, it comes with franking credits attached. It's a little bit confusing, but effectively they gross up the amount of the franking tax and the dividend together to be able to then tax you. So you do get some benefit from having a franked credit, but you'll be in a position where you generally, you might be paying some top-up tax on anything above 30% if your income tax is above 30%.
So I notice there's a couple of questions here. One from Pete saying, is it FTX failure an automatic capital loss, or do we have to wait until the administrators have to finish? So if someone's had a failed crypto...
Yeah, sure. Yeah. So generally speaking, you need to wait till the administration process is finalised. In the instance of FTX, it's so public. I think some people are getting some money back, for example. We had a couple of clients who were insistent on writing, not FTX, but other cryptos off, even though they haven't been quote-unquote written off. And so the caveat to that is, yes, we'll write it off for you, but in the event that it magically appears back in your bank account and you get some money from it, you've got to pay tax on that lot then. So we're best placed, try and wait till administration finishes. However, if in FTX's case, it's looking quite grim. They're not able to get a huge amount of money back, and obviously the preference debt holders, for example, will get their money way before shareholders and any sort of investors. So yeah, something like FTX value is probably something that you can consider writing off, Peter. So yeah, it's always good to check.
Dean asks, Birchie, any pre-30th of June subscription deals for my property tracker?
Spot.
Absolutely not, right? It's whatever the cost is, so cheap. I haven't even looked there. We put up with inflation, $8, $9, something like that.
Yeah.
They're actually going up soon when we get the whole site fixed up, just due to costs. I'm not saying because of inflation, but just due to the cost of the back end of it. There's actually an option there where you can have all the data uploaded for you. So it's like having a bookkeeper service, and that's part of the cost that needs to go up. But what would it cost you to have a bookkeeper per property? If you're spending $50 a year, $80 a year, $100 a year, whatever it is per property, it would cost you a lot more than $100 per property for a bookkeeper. So you've got a bookkeeper there at the back end of it. So it's very, very cheap. Can't do anything with that price. If you do it before 30th of June, you can claim it as a cost for this financial year. You can pay the 1 year upfront package. But yeah, with that, I've got people that have been on there since 2011, so it's about 12 years now that people have been on there, and it's I
think even more so than the bookkeeping assets, it's quite useful just to have something you can open up. It's consolidated. You've sent all your paperwork there. In the event of an audit, in the event of any loss, theft, or fire, for example, it's all there, right? So it's a cheap insurance.
Unfortunately, all these floods that are happening, all my records got stuck in the basement. No joke.
All right, let's move on. So trading as a business, I think that's going to be a different sort of webinar. So if you are trading as a business, it's the tax and the whole scenario. If you had the side business, or you had, a lot of guys have e-commerce and all the other type of stuff that they're doing, which is all good. There are some nuances there which take a little bit of time, so we might not have time, but maybe someone can come back and talk about trading as a business. Big one, crypto trigger tax events. So basically, think about crypto as shares, think about crypto as any type of stock. If it changes form, size, format, anything like that, usually those are trigger events from a tax point of view. If you swap them, if you get airdrops, if you get staking rewards, all those types of tax trigger events. Not all of them are capital gains, some of them are income driven, but generally speaking, any type of change in your crypto will elicit a tax event. So it is really important you use something like Coinly or CoinTracker or Crypto Tax Calculator, I think it is as well. I don't know if that one's that great though, but give it a go. It's really important because the tax office is really aware of it. I've had clients who have had pretty significant crypto gains and not claim it, and then the tax office come back despite our asking, for example. So one of the biggest places that they're going to focus on. Obviously, crypto's had a bit of a winter for the last 18 months, but that also means that people are selling down. And so they're going to be looking at that quite closely.
And what would happen, Red, just in the off chance that something terrible happened? Let's say that I had a Trezor. Trezor's a security device that you would hold, self-storage. If I had a Trezor and it got lost due to theft, could that be claimed instantly?
It can. Absolutely it can. So if you have those and you can show those. But if that Trezor and or any of its crypto came back and magically claimed its way back onto the blockchain into one of your...
If someone stole it.
Someone stole it, yeah, absolutely.
Someone else took the money.
Yeah, that's fine. So if it magically comes back, then you've got to pay tax on the gains.
It's never happened to me, but just thought it'd be I'm sure there's a lot of people that it might happen to might be watching.
A lot of people lost their Trezors.
Yeah, they got lost due to theft. So it'd be a tax write-off.
It would be, yeah. Capital loss.
Capital loss.
Capital loss, not against your income.
Okay. Don't know where I placed them.
Now this heading is wrong. You can't avoid capital gains tax. You can minimise it, right? So capital gains tax is always a bit of a sticky one. So we spoke about it a little bit earlier, but holding investments for more than 12 months helps you minimise capital gains tax.
But if you lived in it, right? So let's just go back to the how to avoid it, right? Like we're not trying to avoid anything, right? We want to pay our fair share. We're upstanding citizens, and we really love the government. They're doing a great job, and we really want them to control us a bit more. But that's a separate story. To avoid it, like if I bought a house, let's say I bought my first property, and my intention was to live in it, but I didn't live in it.
Yeah.
And then in 3 years' time, I decided to sell it. I've rented it the whole time. Would that be classed as my principal place of residence?
No, unfortunately not. You have to have lived in it for a period of not 6 months, but a period. You have to have lived in it.
What about the 6-year rule?
Yeah, so you've had to live in it first, right? So you've had to actually occupy it as your principal place of residence, and potentially justify and show that. So with consumptive bills, gas, water, electricity, Foxtel, Netflix, whatever it might be. And if you've then subsequently moved out of it and not had another principal place of residence, then you're in a position where you're excluded from paying capital gains tax for a period of 6 years on that property under the temporary absence rule. So that can help you reduce your capital gains tax. If you exceed that 6-year period, then there's some adjustments with regard to the cost base, but you never avoid it, but you just minimise it. So yeah, probably should update that header, but there are a number of different ways that you can minimise capital gains with regard to your principal place of residence. With properties that you have rented out from a long time, it's very difficult other than the 12-month rule. One thing that you probably touched on inadvertently there is that if you had your business running out of your home, and you're trying to claim your mortgage and all that other type of stuff with regard to the holding costs, we don't generally recommend that, because that means that your largest free capital gains asset suddenly becomes taxable, right? For a couple of $1,000 a month or whatever it might be in terms of holding costs you're trying to claim, you end up paying a lot of tax on the way out. Offset gains with losses. So if you have things like a Trezor go missing, for example, I took a bath on crypto when all the Ripple and everything went down, and I sold that when I had other gains in some shares and a property owned with my in-laws, and so then I sold that because I knew it wasn't going to come back, and so then I'm going to pay a little bit less capital gains tax, right? So ordering your losses to offset your gains is useful. You must have the loss in place prior to the gain, or in the same financial year ideally. Tax efficient account structures and investment vehicles, that can sometimes help depending on how sophisticated or complex your affairs are. So whether or not, for example, you have a trust, for example, which has made a loss, or you've got a company which has made a loss on a particular asset, and then you have another business which then distributes money to that company. Those type of things can affect you in terms of positive tax benefits.
What would happen if I bought a car this week because my rental property's got a half dozen rental properties, and occasionally I have to go and do some maintenance on it. But when I go to do the maintenance, my hatchback or my sports car or something like that doesn't allow me to drive to them and carry all things. What would happen if I went and bought a new vehicle, like a Hilux or something, right? Could I claim that?
If you, against your personal income or through a business?
Against my personal income, because I bought it for those personal properties. Like I need.
No, unfortunately not. No, we've tried. It's been tried. So many times where clients are effectively managing or administering their properties and using an investment vehicle to be able to do so. Generally speaking, because of the arm's length rule, it doesn't really work.
What about if I was to set up a company to do handyman on my properties? And then
it's all been tried.
So would that be claimable?
It depends. So if you're only looking after your own properties and you've got a really strict set of circumstances in which you're carrying out the work and it's done at market rates and whatnot, then it can. But again, because of the arm's length rule, sometimes it gets knocked back. We had a client actually who was doing it. He was doing it effectively, to be honest with you, because he had a number of Airbnbs many years ago, and the tax office audited the scenario, and so the structure wasn't commercial in nature. He was doing everything right, to be totally fair, but they just deemed that the structure wasn't arm's length enough. So we wouldn't necessarily recommend that. It'd be if you had a business that you wanted to hop alongside. You might have.
My brother had a business,
of
property maintenance, and he maintained my properties, and he bought a car, and then I paid him the.
If he had a business,
he had a company.
If he had a business, then he could purchase the car, and that car would affect him from a tax point of view, for sure. The last one's actually interesting. Plan your asset sales strategically. So what you don't want to do is washing. Washing is basically where you sell a particular share at a particular price to extract a loss out of that share, and then buy the same particular asset in the same particular format and number after the tax year ends. So basically crystallizing a loss, then you shouldn't rebuy it. That's called washing. It's illegal. You can't do it. Now, if the case is that you sell a whole bunch of shares, indiscriminately, you go, look, I don't want these shares anymore, and you sell them, and then you happen to end up buying some back, not of the same type, not of the same exact nature, for example, but 3, 6, 8, 12, 15 months later, and that's fine. It's normal trading, right? But a lot of people have gone through the process of where they sell to crystallize losses and then they buy again. The effectiveness of it, I don't exactly know, because, if you've created that loss and then you sell it and you made a gain, you neutralize it. But it really depends on what time you buy it, right? So if you're selling it at a low price to crystallize your loss, you might as well just hold on to the ride anyway. Look, it's something that a lot of people do, so you should try and avoid that.
Washing, it sounds like fun.
Do you wash?
I wash daily.
All right, the importance of finding a good property accountant. I tell this to clients all the time. We're not in the business of divorcing clients from their property accountants. All property accountants, in my respect, they do an okay job.
But most accountants aren't as fun as you.
Yeah, you said that. Maybe they are. We don't know. So maximising deductions is always useful. Compliance with tax law is extremely important. Structuring advice is very, very important as well. Capital gains tax planning is also very useful. We get a lot of questions around that. Financial analysis, which is what we do. We don't necessarily call it financial analysis. We do the property portfolio reviews from a tax and cash flow point of view, structure reviews each year to say whether or not you need a trust or, is a super fund eligible for you, speak to a financial planner, all those different types of things where it gives you a little bit more insight to your property portfolio. Not every single client takes us up on that. And to be fair, not every single client we reach out to, we always give clients a very clean and clear airway between us to be able to get in front of us. So if you are one of our clients, just schedule appointments with us. We don't charge extra for those meetings, for example, at the end of the year. We try and get that so that you grow, we grow scenario. And the penultimate point there, talking person to person, it's really important that if you value their opinion of your property accountant, your accountant, or your tax accountant, then have a conversation with them. Be realistic about what it is that you'd like to do. Hear about what they would have to say. If your only mode of discussion is, I don't like paying tax, then the conversation is going to be short, right? I think what Nathan and I always talk about is that what can you do to keep going forward? I think that's a much more productive conversation. Now, tax is important, but it's only ever 45% of the problem, right? And we've got a lot of clients who have done kind of well for themselves, but don't really know how they got there.
Mm-hmm.
And then when things change, they're sort of asking questions which you don't expect, right? Mm. And that kind of leads me to believe that if you're only asking questions to get a particular answer, as opposed to looking at the long term,
or clarity on your bigger
the bigger picture, then you kind of just get stuck going, okay, well, I've got to get through page 1 of this document, so I've got through it. Now I'll turn it away. You don't read the rest of the whole book, right? And I think, to your credit, that's what you do well with clients. I've heard your map sessions where you go, okay, well, the property that you're selling them is just a stepping stone.
Yes, part of
the journey, right? Yeah. But if you go, you're going to spend the next 4 hours talking about this property, you're not going to get anywhere, right?
Yeah.
And so, the credit to the time that you provide to clients is that point. You're talking person to person, right? So you're good at property, no doubt. You're good at sourcing property, negotiating property, no doubt. But you don't have to convince people of that. Your job is you're just talking to them.
The property
will sell itself,
because
right?
The numbers have to stack up. So,
and I think to some extent, all the good advisors, lawyers, accountants, that I've incurred, whether they're at the big four, whether they're at smaller firms, they're the guys who are able to talk to you as a person, as an individual, and understand your particular scenario and say, you know what, this makes sense. Let's look, a bit further down the road. So that's probably one of my best pieces of advice I've learned over the last 10 years. And this is our 10th year working together, Nate. So,
10 years on the trot. There we go. Well done, mate.
A little bit fat on you, a bit thinner now. But,
A bit thinner now, but still fat, but so I need to lose some weight still. And the rat sale goes. So,
that's it.
Then we've got our next one, which is just question and answer. So,
Luke's one there is good.
There's a beautiful question here. There's a beautiful question. There's lots of questions here, but there's a beautiful question there from Luke, right? And the question says, great content tonight, Jen. So that's
thank you.
The question is, are you seeing many audits from the ATO on property investors? And what does best practice in terms of record keeping look like to keep the ATO happy? That's a fucking 10 out of 10 question,
yeah,
Luke.
Absolutely.
You should be asking that no matter whether it's your broker, what does the bank look for me? What does this look like? So that's a very good question, Luke.
Yeah.
Over here.
And look, again, I couldn't say better than Nathan. It's a really good question. In terms of best practice, it is really about being as clear, plain, as transparent on those particular deductions. If you have things like mixed loans or you have cross-collateralized loans, we can work those out for you. We can understand what your originating debt was, and we can make those make those assessments for you. But in things like strata, in things like repairs and maintenance, do things right. Get your property manager to take photos and show that the carpet's been torn up in 100 different places, and you can't just replace that one square. You actually got to do the whole room, and so then nothing you can do. It's a repair. And if you've got an AC that's gone out, get your electrician to take a photo of the burnt out circuit board or whatever it might be. So the more information and the more data you can give us and the more evidence you can give us, Luke, that's the best. And we've seen with clients and in the ATO, you send that information over in one go, it's all clean, clear and nice. They wrap up that audit in the same day. We had a client who was audited for about $45,000 worth of things, and the ATO was going, they're losing their minds. And then I just sat down and walked them through every single thing. I had one of my offsiders there with me, and then they go, look, we don't agree with this $200 one. Yeah. Are you happy to let it go through to the gates? I said, yep, I am. Yeah. Client, are you happy? Yep. You had to pay an extra $65 in tax, and that was it, right?
What a speeding ticket.
Yeah, exactly right. So, you credit to them, they're good, they're logical, they're practical. So I think don't fear them, work with them.
Yeah, even when I get talking to the ATO, I'm just like, we're not even big dicks on whether to make happy, right?
Luke asked another question. Can a buyer's agency fee be claimed? Unfortunately, no. Tax office is very strict about it. We still are working on that with Nathan's team in terms of getting the...
Well, it says here, they're saying there, especially if the vendor's name has educated, like be educated, for example. I feel that, a great deal of what we do is education, right?
Service oriented, in my opinion.
Exactly. Right? So just like yourself, I don't charge a fee for a catch up on a phone call or anything like that. And I'm talking to my clients about increasing the cash flow on the rental properties and all that's a part of the overall sort of service. So you need to work out, I guess, what value you see from that to improve your cash flow and improve your position. And that's what you're doing with us. If you might feel that you're getting 90% of the value out of the buyer's agency for improving your current position and advice, well then that may be it, right?
Yeah.
Every level of advice that comes from me is different. So, I think it's important how you structure your affairs and speaking to your accountant. And I've got some questions here that I might jump in and answer on that. One was, you can answer this one about the getting the rent in advance. But there was another one here. Tyson said, do you have any banks you would recommend for a self-managed super fund loan? We do millions, tens of millions of dollars a month, hundreds of millions of dollars a month worth of loans that we originate and write for our investors. Out of that, I'd say maybe like 10% of that is to super funds. And there's a few banks. It's a very different type of lending structure, and there's only a few banks that do look after that. If you do want access, it's not a question for Ridhwan or myself. It's best to speak to Rose and the team at Zinger. Reach out to the team. I actually think there's the next slide over. We'll just keep answering the question, but we'll take the slide away. Where are we? There we go. So follow the links, email us, or book an appointment with the discovery session, have a chat with the team, and I'll put you in contact with the finance team to discuss that. If you have questions for Ridhwan, just email the team. They'll do an introduction with you over to Ridhwan and make sure you're prepared and ready for tax season, or you can find Ridhwan at One Path Accountants. What was the other questions? So do you want to answer this one about, so there's a company out there called Future Rent, right? And you can get your rent paid in advance, basically. So they tell a different story because they've got, controls. They're not giving you a loan, they're just helping you pay your rent in advance. So technically you're taking your rent.
You might actually see me on one of their ads because one of my mates is associated with it. So I was having a bit of a session with them. So Future Rent is basically where the rent that you would receive in a year, they pay you up front. There's a fee for that, and that fee is effectively in the form of interest, so it becomes a tax deduction for you, and or your rent goes down, so the net effect is the same. And I think they now allow you to pay back that rent that you've quote unquote taken in advance over a longer period. So I think it's like 18 months. And so basically what happens is you get, if your rent is 50 grand for the year, for example, you might get 40 up front. 10 of it goes back through to your real estate agent to be able to continue to pay your bills and everything like that. And then from your future rent amounts that you receive, a portion goes back to future rent to pay your debt off,
Mhm.
and a portion goes back to you to continue managing your property. So it's a cash flow, it's unlocking effectively. So if you're using it, a lot of clients basically use it to jumpstart a second purchase or a reno, or school fees in some instances.
Piano lessons.
Yeah, piano lessons. So yeah, do you use companies like FutureIn? I think Nathan's spoken to FutureIn and their owners a number of times. I think they have like some discussions on how effective it would be.
Some people it works for.
Yeah, some people.
I have no vested interest in it or anything like that.
Yeah.
It's a service there.
But yeah, look, they've got a really good service on their team. I know a lot of the team pretty well. In my opinion, they've done pretty well with the business and what they've done. And I've seen it. Some clients use it. It's good. If you think it's going to be something that you need to get that income up front and utilize it effectively, then yeah, it's definitely something you can go for.
So the question, someone just wrote here that they claim that our fee is an education fee, because I think it is education. I think lots of education here. And Be Educated, which is the company, it's education by nature, I guess. If someone was paying a monthly subscription of like, I don't know, paid it out over 12 months, the monthly subscription, I guess it would be more of an education fee if you paid it over a longer period of time. So it depends, because you're not paying it all up front. It's not just an upfront fee for a service that was done. It was an education fee over a period of 12 months.
All power to you. Right? Yeah. If you can get it through, then, all power to you.
Here's one here. I'm born in 1969, my wife 1972. How old do we have to be to retire so we don't pay or minimise tax in our super fund?
So I think that would be probably 57 or 58. For 57 for you, I think, and then 58 maybe for your wife. There's a banding that you have to work in. It's no earlier than 55, but it's no later than 58 really. So anywhere between 57 and 58, I think, for you guys. So basically you can start a trap, or you can start the transition to retire. Obviously when you hit 60, then you're in a position where you can actually fully retire, and then you can access your pension in tax-free format. So yeah, you can just get in front of us, George, and we can have that chat and sort that out for you.
Beautiful. Any other questions coming from the community? Jerry said, awesome session, guys. Well done, and many thanks.
Thanks, Jerry.
And appreciate everyone tuning in and listening to what we have to say. There was another question here from Lisa that said, can you explain the difference between capital works and capital allowance and how the two differ when claiming it at tax time?
They're both pretty similar. So I think what you're referring to there is the two arms of depreciation. So one is like kind of your loose fixtures and fittings, for example. So your tabletops, desktops, kitchen tops, versus your structural elements, I think. Is that what you're referring to?
I actually, when I read it, I was thinking the difference between like claiming it up front as a capital expenditure or claiming it as a expenditure.
Yeah, so repairs and maintenance versus capital, right? If that's what you're referring to, Lisa, so it could be either or two, but just to recap on that, you have two arms of depreciation. So one is your loose furniture, fittings and tops and all that type of stuff. The other type of capital deduction you have is what you can't see. That's a 2.5% for the next 40 years. If, Lisa, you're talking about repairs and maintenance versus depreciation, for example, so if something is broken, Natio's got a pretty good example of that. If you've got a handle on a railing on a staircase and a portion of it is broken, but you can't fix that portion without actually changing the whole railing, I'm sure it's significantly improving the railing. So you're going from like wood to glass or glass to aluminium or something like that, that's an improvement. But if you're replacing it like for like, and you just got to replace that extra length, then you get to write that repair off. Similarly, carpet, paint, blinds, and all those things, depending on the nature of the damage, if it's significant enough that you have to replace it, and it's okay. But if you've got a cracked sink in your bathroom and that's led to water ingress and you've got to destroy the whole bathroom to get it all done, because of the nature of that whole improvement, that will be considered capital works, right?
The other thing I was just thinking of, Brett, I've never thought about this before, but it's like the creative producers flow, right? And Ridhwan's like stopping the question all day. I text this bloke, just random shit, right? He's like, fuck, leave me alone, right? I'm sure he does.
No.
Like he's like my counselor or something, right? But think about this, right? What about if everyone was to go through their building report, Ridhwan, when they buy a property? And it always has 1,000 different disclaimers in there, right? The balcony railing is not up to code, right? Because it's not up to code, we would have to replace it, would we not?
Yep, that's an improvement.
Okay.
It's not a repair.
Well, it's got to be repaired to code.
Yeah, so because you're replacing the entire thing, right?
Yeah, but repairing it to code.
No, it's getting it up to standard, generally speaking, would be. But, you have a point, right? For example, if you bought something and it's...
I don't want to fix it.
Yeah, but it's kind of like the pool fence thing, right?
Yeah. So the pool fencing, it doesn't lock and it doesn't meet the code, and we have to replace it because the council's come to us and said, replace your pool fence.
Yeah.
Council's ordered us to change the pool fence. I ain't fucking upgrading my property. I'm just replacing the pool fence because council said so.
It can be certainly something that we look at and say, okay, well, what's the scope to be able to write this off because it was unexpected, for example. Depending on when the tenants are in there, is an issue repair, what does it look like, or is it a case where it's been an emergency, those type of things?
If I was to go, because there's a big difference between repairs and renovation, right? Correct. So just remember the 2 R's, repairs or renos, right? Now, if I had a property and I wanted to take the back wall out and add some glass sliding doors or some shit on the back of it, that would be classed as a renovation, right? Yes. However, if I found some termites in that back wall and I decided to take the gyprock off the wall and check it out, and I realized that, wow, there's some termites in there, and I wanted to restructure it a bit, then the effort of me having to put the new gyprock on, if I put a door in, might maybe take the door off because that would be, the $1,000 for the door would need to go as a capital improvement. But then, I went to the door option because it's cheaper than relaying the bricks and relaying the cladding and all that sort of stuff. Would that be classed as a repair?
You'd have a lot more scope. You have something like termite damage and you have to pull down a whole wall and repair a whole bunch of different stuff. Yeah, it can be the case. Yeah, for sure.
Bit of wood rot.
Bit of everything.
Yeah, so I think that, the tax system, they require for you to provide evidence of what you've got.
Mitch has got one there. The smoke alarms is always a repair. We always write it off.
Yeah.
It's like a mandatory thing.
Yeah. George said, please send an email with a link tomorrow so I can watch this webinar again a few times so I can comprehend everything between Ridhwan has talked about tonight. You should automatically get an email from us saying, hey, here's a replay of it. So
George, I'll get the office to give you a call and book you in as well so we can have a chat.
Luke had a good question here too. And he said, the budget had a 20 grand write-off for capital items for small businesses. Can the property investors be considered small businesses and entitled to an immediate write-off?
You're lovely if it was, Luke, but they don't consider property investment where you own direct property as a business.
But once again, if I was to, if my brother had a building business and he was to do some work for me for free, right, because he came to my property, did some work, and it wasn't up to scratch, and I refused to pay the invoice, so I have to write that off the loss, would that be classed as a loss?
It's going to be a loss, yeah, fine. But...
Yeah. So it's an off-balance sheet, just very similar to the budget here.
I'm not fully with you.
Okay. I'm just asking questions, just randomly.
No, as in Luke, so unfortunately the property investment space is not considered the enterprise of a small business. Now, often, clients do Airbnb and they do all these other different things to be able to have businesses on the side in relation to property. Some people do property advice, etc. So if you had a genuine ABN business running, then you had capital items that you could write off for 20 grand, it's possible, but not direct relation to your property now.
So I guess it's the presentation and the justification and the reasoning.
To the structure of it, yeah.
Yeah. Cool. Luke goes, Nathan, I love you challenging the status quo on tax. I question everything. I challenge everything. I'll be one of the most annoying. Like the system, right? The system where you were born, right? Like you go to school, your kids go to school, the bell goes off, you got to obey, don't ask questions, this is what you need to do. And everyone gets told what they need to do, right?
Yeah.
But I think it's important just to keep questioning, right? Just keep questioning. Like, what does that mean? What does that do, right? And I think that's important for people to do it because pretty good thinking ain't too common out there nowadays. So yeah.
I think probably the best takeaway and last bits of advice is I think always questions are fantastic. looking at tax, looking at how to affect change within your tax position is fantastic, but always think the bigger picture, right? Because again, if I use Nathan as an example, taxes are always something that you ask, but it's not necessarily the reason that you buy or don't buy something.
No, I don't care about the taxes later. He said he referenced what Nathan was saying. If I buy a property that needs a new roof, that would be capital works to be depreciated or repair that can be written off. I feel like the answer is going to be it's a capital improvement, but like Nathan said, I didn't want to replace the roof that is just damaged. So if you're buying the property with a roof that is damaged already, well then you're buying it with the need to have to do it. But if the property you bought it and the roof had no problem with it and you needed to go and replace it because the water was leaking through and affecting the gyprock and all that sort of stuff, well then that would be a repair.
Yeah, they'll consider it. So what you're talking about, Heath, there is what's called initial repair. When you buy a property, it's already got the existing damage. You can't fix that and then claim a deduction for it. But it's they want you to consider it like a black hole expense, but we write it off over a capital works provision. So if you've got a property, let's say your property was uninsured, right, and the storm came and ripped the roof off, you have to replace it to get it back up and running again. If it's all of the roof, it's all of the roof. You've got to be able to show that, demonstrate that with photos and whatnot and everything that you've done. But if you're just replacing the roof, because a portion of it is...
There's the roof on the floor. It's fucking thrown on the floor.
There's a portion of the roof, then that portion you replace and repair. So, yeah.
So just make sure when you take the photos, you take the screws out and you put the screws back in with the sheets missing. I'm joking, guys.
That's a good one to end on.
On that note, guys, happy tax season. Reach out to us. You know where to find us. Thanks a lot for coming in today, Rid.
No worries. Thanks for having me, as
always. Keep being awesome, guys. Make sure these commies don't steal your money. So we'll catch up soon. Bye for now.
See you guys.